The Fed loses patience. In its latest monetary statement, the U.S. Federal Reserve decides to drop the pledge that it will be patient in raising interest rates. The omission suggests policymakers have taken another step towards its first rate hike since 2006. So what does that mean for the markets? And more importantly, what does it mean for your investments? We have a panel of experts standing by to weigh in. Welcome to the show. I'm Catherine Murray. And over the next half hour, we are going to bring you an in-depth look into the latest statement from the Fed, whether policymakers are on the right path, what the economic implications are, and what markets might look like as we await a possible rate hike in June. Joining me for this conversation is Peter Schiff, the CEO and Chief Global Strategist at Euro Pacific Capital, Benjamin Tall, Deputy Chief Economist at CIBC World Markets, and Tom Dezuras, he's the Head of Fixed Income Research at Strategas. Gentlemen, great to be with all of you today. I think probably a real reaction in the market, one that probably wasn't expected. Peter, I want to start with you. I think you've been calling for the Fed to increase rates or get off this easing path. They did just the opposite today, don't you think?
Well, I haven't been calling for them to raise rates in that I think they should, but I know that they won't. Look, if you look at the Fed's actual statement, they're more dovish now than they were when the word patient was part of the statement, which begs the question, why remove the word patient if they're just as patient now as before? And I think the Fed is still trying to bluff. They're trying to pretend that they remain on this course, headed for a destination that they will never reach, which is a rate hike. That is not what the Fed is going to do next. The next thing the Fed is going to do is launch QE4. It's going to fail just as miserably as QEs 1, 2, and 3, but they're going to do it.
Benjamin, what's your reaction to this? What do you think? What did you see from the Fed today, and what will they do next?
Well, I think that the discussion now is turning to the magnitude as opposed to the timing. And I think that we were discussing too much the timing of the move, which I don't think is important. You know, June, September, who cares? The magnitude is much more important. And for the first time, I think that the Fed is changing the discussion. I think that the Fed is dying to raise interest rates, there is a huge amount of fear to actually do that. I think that they know that the market is leading the Fed, not the other way around. They're trying to break the cycle, but the risk that they're facing is asymmetrical. Move now, too early, too much, and you kill this recovery. They really don't want to do it. Therefore, from a risk management perspective, they will basically start moving maybe September, but they will go very, very slowly. And for the first time, the market is starting to focus on this reality.
Tom, how do you respond to what we've just been talking about, and what's your reaction to the Fed?
Well, first I'd say the timing as well as the pace both matter here. And I think the statement here was a little bit more dovish than we would have expected. I think although they dropped the patient term, I think one thing to take away from this is that they were very kind of explicit that April is not on the table. And more importantly for June, they still have to see an improvement in the labor market, and they still have to see a move in inflation back towards their target before they're going to hike. Now, what's interesting is that I interpret that to mean not only does inflation have to begin to move, not only does inflation have to stabilize, but inflation probably has to begin to actually move higher. And as long as the dollar is rallying, I don't see that happening. So I think if the Fed were to come out and sound a little bit hawkish, the dollar would have rallied, and I think that would have made it very difficult for the Fed to push realized inflation back towards its target.
I wonder, though, with respect to the fact that inflation doesn't seem to be anywhere near where they want it to be, the median Fed funds rate, just even for 2015, let alone 2016, has been lowered quite dramatically. 0.625% are the expectations versus 1.125% back in December. So what is that telling us, Peter, then in terms of truly what they can do next?
Again, this is all pretense, because the U.S. economy is not recovering from anything. We have a gigantic bubble, and the Fed just doesn't want to prick it. And if they raise rates, they will. But the problem is the absence of QE. The air is already coming out of this bubble rapidly, and we're heading towards another recession unless the Fed, unfortunately, does another round of quantitative easing. The problem is once you start to stimulate an economy the way the Fed has, there is no way out. They cannot turn off the monetary spigots without producing a severe recession and a financial crisis worse than the one we had in 2008. But the Fed cannot come out and admit that, so it plays these word games. And by the way, the absence of inflation is not bad. Creating inflation is not a good thing, right? The economy will not benefit from more inflation. The reason the Fed wants inflation is because it wants to sustain the asset bubbles that it took so much time to inflate, and it wants to help bail out the U.S. government and every other debtor in the United States that has borrowed more money than they can repay, and the only hope they have is defaulting through inflation. That's their game plan.
What does that mean, though, in terms of the economic recovery? Where does that play out here, Benjamin?
Well, first of all, I think that, listen, quantitative easing was the right thing to do. Quantitative easing was the right thing to do because otherwise we would have been in 1929 all over again. So for me, this was the right thing to do. You can discuss to what extent they did it too much, but I think it was the right thing to do. And now they're basically trying to get out of it and start to raise interest rates because eventually there will be another recession and you need some ammunition. Again, they are dying to raise interest rates and they will take any opportunity to do so, and I think they will have to do it. In fact, I believe that interest rates should be much higher than they are now. In fact, I believe that today interest rates in the US should be at about 2%, not 0, but that's a different story. I think that the last time I checked, the US economy was creating 250K amount in terms of new jobs. That's not a recession in my book.
But Benjamin, what's perhaps so confusing here is that
part-time jobs.
You go ahead. Yeah, they're part-time jobs.
That's nonsense. That's nonsense.
We're destroying full-time jobs.
That's
we're
true.
creating jobs for older people who used to be retired. And now they have to work to pay their electric bill.
That's not true. The fastest growing segment of the labor market is now young people. The fastest segment of the labor market is now young people. That was true a year ago, not now.
That's where the labor force That's where labor force participation has collapsed among young people.
I'm talking about the last...
You got to get your facts straight.
No, look at the last 6 months and you will see that it's very different. You will see household formation starting to rise because those young people are starting to get out of the basements. They will start to establish households and they will start buying houses. Again, I'm not extremely bullish on the US economy, but I think that... One second. I think it's starting. Yeah. The issue is to look forward, not backward. And forward, I think, looks much better. Again, I'm not bullish...
It's starting in your imagination.
Okay, let's stop now. Let me say something, okay?
The share of first-time home buyers is the lowest it's ever been. Home ownership is at generational lows. Young people can't afford to buy a house. They can barely afford to rent an apartment.
Your job is look at the first derivative, not on the history. The first derivative is positive. That's what you have to do.
I want to bring Tom in. Tom, here's the issue, and here's why this is so interesting and why we watch the Fed so closely and why the market's completely done a reversal from this morning is because the debate is so strong out there. Tom, where do you sit in terms of how strong the U.S. economy is, if and when they can raise rates? Benjamin's saying that they want to. Peter Schiff says they don't want to raise rates. What do you think?
Well, I think the U.S. economy is improving. There's no doubt about that. The question is whether the U.S. economy, particularly the housing market, is strong enough to withstand higher rates. I would argue the U.S. economy will be probably before the end of this year, but the housing market still really isn't strong enough to withstand substantially higher rates. And one of the problems you face if you're the Fed is if you go raise rates, particularly if you raise rates and you spook the market, so you raise in June and the market begins to price in 2, 3, 4 rate hikes in 2015, the yield curve is going to push higher. And the reason why the yield curve is going to push higher is because if you look at 5-year and 10-year yields, particularly in the belly of the curve, interest rates are not consistent. Long bond yields are not consistent with what the expected future path of interest rates, short rates, is going to be. So as a consequence, like a spring that's overly compressed, when you let it go, it overshoots. That was the taper tantrum in 2013. There's a very real chance that if the Fed were to pull back from monetary policy quite rapidly now, you get a tightening tantrum this time around, and that can do real harm to the economy. So the economy is improving, yes, but the economy is still very fragile, and this is a consequence of trying to manage expectations. You just cannot manage expectations into a very narrow channel. And I think that's what the Fed is trying to do here.
That's an excellent point.
The U.S. economy, the U.S. economy has never been in worse shape than it is right now. You just can't perceive that because the Fed hasn't taken away all the monetary supports. But this is not a genuine recovery that you're talking about. This is a gigantic bubble. This is bigger than the housing bubble. It's bigger than the dot-com bubble combined. You throw the bond market bubble in there. This is all fantasy. The Fed needs to kill this recovery because it's phony. The reason that the economy is in so much worse shape now was because the Federal Reserve, with its monetary policy, 0% interest rates, quantitative easing, prevented the markets from fixing all the problems that were the result of interest rates being too low in the first place. So instead of dealing with our problems, the Fed made them a lot worse. And now, unfortunately, the crisis that we're looking at in the future is going to be much worse than the one that we would have experienced in 2008 had the Fed done the right thing and not done all this stimulus.
Gentlemen, just stay right there with me for 1 second. We're going to take a short commercial break, and we're going to talk about how the Fed is really impacting the global markets and, importantly as well, what it means for you at home. We are back with Peter Schiff of Euro Pacific Capital, Benjamin Tal of CIBC World Markets, and Tom Titsouris of Strategas. And Benjamin, I want to start with you right here. When you take a look at the Fed and the Fed's action, the reason why we care so much is because they're essentially setting asset prices across the globe. So what's the impact from an economic perspective in terms of what the Fed is or is not doing?
Well, first of all, I think that the point that was made earlier is a very good point about, managing expectations. I think that that's exactly what's happening. You have a situation in which the Fed is trying to raise interest rates, but at the same time, they don't want to kill the market, as suggested earlier. And I think what's the solution here? Basically, from a risk management perspective, you start raising interest rates, let's say September, but you go very slowly, 25 basis points, you pause a little bit, you wait 1 or 2 meetings, you go another 25 basis points, and basically Yellen is telling us that she's going to do so. It's not going to be a Greenspan type increase, like in 2004. It's going to be a much more measured impact. Therefore, the damage to the long end of the curve will be much more gradual, and I think that's basically what she's trying to do. So I do agree that interest rates should be higher. I do agree that this bond market is expensive and it probably will correct, but not everything has to end with smoke.
Tom, what about you in terms of understanding what the Fed is doing and the ripple effects or the derivative effects that's going to have on the Canadian economy, the U.S. economy, but also, of course, other central bankers? We haven't even gotten to the discussion that they cited, which are the international developments that they'll take into consideration as well. You've got all these other central bankers lowering rates and or stimulating their own economies. How does all of this play in there?
Well, this may very well raise the possibility of rate cuts in places like Canada, Australia. I think if you're the governor of the Bank of Canada, you want to see the Canadian dollar weaken, and you'd love to see it happen without the Fed raising rates. What this has done is it's possibly pushed rate hike expectations back a little bit further. We believe at Strategas, liftoff is coming in September, so this doesn't change our outlook all that much. But I do think the market did have some kind of fat tail risk that there was a hike in June, and that fat tail risk, I haven't seen the Fed funds futures this afternoon, but presumably those probabilities have dropped a little bit, and that probably causes the dollar to weaken a little bit, the U.S. dollar to weaken a little bit, particularly against places like Canada and Australia and Mexico. So I think that probably puts a little wrinkle in the plans of the Bank of Canada. They'd like to see the Canadian dollar weaken, but nonetheless, this is supportive of the global economy. This is supportive of the U.S. consumer, and this is probably supportive of the Canadian economy as well. So it's not a negative for the Bank of Canada. It just means that the Canadian dollar is going to retain a little bit more strength in the very near term.
Peter, what about from your perspective as well? We've got to talk about these other central bankers and what they're doing and how that fits into the picture. What do you think?
Well, I think central bankers are behaving very foolishly around the world. They are deliberately cutting interest rates in pursuit of inflation, as if that's the holy grail of economics. I think this is going to backfire. I think the inflation rates around the world are going to end up being much higher than these central banks bargained for. And so I think that what you're going to have is central banks increasing interest rates around the world at the time the Federal Reserve is doing QE4. So I think the world's the currency markets are prepared for the opposite of what's actually going to happen. They think everybody in the world is going to be easing and the Fed is going to be the only central bank tightening. We're going to be doing QE4 and other central banks are going to be trying to put out the inflationary fires that they lit on purpose.
Why would other central bankers be able to pull back on quantitative easing on the back of inflation when we didn't get inflation from the United States' quantitative easing? Why would it be the reverse true outside of the U.S.?
Well, we did get inflation. A lot of it was exported. America has a huge trade deficit, so we export a lot of our inflation. We ship our dollars out and we import goods. So that keeps the lid on it. Plus our CPI is very disingenuous. I mean, prices have risen a lot faster than the government admits. So people are feeling the effects. And of course, we inflated bubbles in the real estate market and the stock market and the bond market, which the Fed is, trying to prevent from popping. But other countries can handle higher interest rates. Other countries aren't mired in debt like the United States. There are responsible countries out there that have been saving and producing and have surpluses. Everybody isn't, a reckless spender and borrower like the United States. Now, there are other countries that are in a problem, too. We're not alone, but I think our problems loom larger, and we're more dependent than any other country on cheap money and these low interest rates. And so our economy will suffer more if the rates go up.
But let's talk about this for a second, because all we're seeing essentially is deflation, if anything. thing. One of my biggest fears over the past couple of years, and it's been wrong, has been the fear of inflation. Can we get to inflation? How do we actually get there? What do you think, Benjamin?
Well, you know what? Inflation is a lagging indicator, and it will come. But you know what? I will take inflation over deflation any day, because we have a 40-year experience fighting inflation. We don't know how to fight deflation or disinflation. And look at Japan.
You don't have to fight deflation. Embrace it. It's a good thing. We all want, that's how your living standard improves. When prices go down, you can buy more stuff.
You know, good luck with that. You know what? Good luck with that.
You've never heard that?
I don't want deflation.
Good luck with that?
If prices are going down, then you don't buy anything today, you don't buy anything tomorrow. Oh, look at Japan. You don't have to look elsewhere. We don't know how to fight inflation.
Sir, do you own a cell phone? Do you own a television set? Do you own a computer? Why aren't you waiting for falling prices? I mean, that is absurd. If you go back to Economics 101, supply and demand, as prices go down, demand goes up. As prices go up, demand goes down. So when prices go down, people buy more. This is complete absurdity.
Okay, good luck. Good luck with that. As I said, good luck with that. I will take inflation over deflation any day, because we don't know how to fight deflation. The minute you see deflation, you really cannot.
It's a good thing you're not running It's a good thing you're not running a store. You go into bankruptcy, raising prices and hoping you got more customers.
Guys, what I would say here.
I don't know that we know how to fight inflation or deflation. Tom, last word to you before we jump to commercial break.
Yeah, what I was going to say is, I think what we want is price stability, right? We don't want inflation. We don't want deflation. I think historically, when you have a fractional reserve banking system where you have, we want price stability. And if you have a fractional reserve banking system where the government is very highly in debt, you probably don't want deflation, because the deflation combined with potentially negative price shocks can cause a destabilization. What you want is price stability. Unfortunately, we do have a government that is very heavily in debt.
There's no evidence that it's ever done that.
I agree.
There's no evidence that falling prices have hurt an economy.
Well, gentlemen, what's interesting...
When you have a high debt load, it does. That's the problem.
What's interesting is we've got so many different views.
That's different. But I'd rather default on debt than inflate it away. But don't try to pretend that consumers need rising prices. They don't.
Gentlemen,
I would agree.
They need a hole in the head.
Gentlemen, you know what? Let's hold the conversation there for 1 second, because obviously there's so many different views here. So at the end of the day, you can position yourself on different sides of the market, and at the end of the day, that's what makes the market. So coming up, we're going to ask our panel how investors should be positioning their portfolios after this Fed decision, and with all of these debates and arguments. We'll be right back. We are back with Peter Schiff of Euro Pacific Capital, Benjamin Tal of CIBC World Markets, and Tom Titsaris of Strategas. A lot of debate going on, and the big question, of course, is what do you do with all this information? How do you position your investments? Tom, I want to start with you in terms of fixed income. What do you do here?
Well, I think what this has done, the Fed has kind of given the bond markets kind of a stay of execution again. We are not likely to want to reach for yield in this environment. Whenever the Fed has come out and said there's been some kind of hawkish rhetoric and then they pulled back, you've gotten a quick reach for yield. And I think that's what you're seeing today in the bond market. 2-year yields, 10-year yields are rallying. The Canadian dollar is rallying. The Aussie dollar is rallying. High yield is almost certainly rallying with the equity markets. We want to avoid reaching. What we want to do is we want to actually begin to leg into taking some profit here. We actually had a note out this morning talking about how late cycle signals are starting to indicate that the high yield market is starting to get a little bit rich. Likewise, we look at the belly of the U.S. Treasury curve and we see a tremendous overbought environment when you consider that even if the Fed doesn't reach a terminal Fed funds rate of 3%, 4%, a 10-year yield of 2% or sub 2%, which is probably below what the Fed funds rate was going to be when the Fed finishes tightening, that doesn't make a lot of sense to us. So what we think is going to happen here is eventually this year the Fed is going to tighten, and that means the belly of the U.S. curve is going to shift higher. Spreads on spread products such as investment grade as well as high yield corporates are going to widen.
Right.
The U.S. dollar is once again going to begin to rally, and I think that's a time to begin to take a little bit more conservative approach in your portfolio.
Peter, let me turn to you now. It sounds like with all the quantitative easing, you've got concern that there are bubbles in the marketplace. What do you buy? What do you avoid?
You got to sell this rally in the dollar. This may be one of the last great opportunities to bail on the U.S. currency, and that certainly includes U.S. dollar-denominated debt like treasuries. Inflation may be good for debtors, but it's lousy for creditors, and it's even worse for an economy. But you got to get out of the U.S., buy this dip in the hard assets, buy gold, buy oil, buy strategic select equities around the world. Avoid the U.S., but there are pockets of economic strength. There are countries where I think you've got much better economic fundamentals than you do in the United States. But the case for the U.S. economy, for the U.S. dollar, is way overdone. It's a very crowded trade. People have this completely wrong. I think people are more wrong right now about the U.S. than they were on the eve of the 2008 financial crisis or at the peak of the dot-com bubble.
Benjamin, what about you? What do you do here?
Yeah, I don't like the bond market. I think that the bond market is expensive. I'm getting out of the bond market. I think that the U.S., I totally agree, it's a very crowded trade. Everybody loves the U.S., and usually when that's the case, it's very risky. Therefore, in the U.S., I will be extremely selective. I will go with very good names because you have to really go with quality there. In Canada, I actually will go with energy. I think that the energy market was punished for good reason, but many good players did not really participate in this disaster, and therefore they were punished for no good reason. I think that there are some names in energy that I will buy. I like anything to do with the U.S. housing market. In fact, I think that's the only part that will surprise on the upside, and therefore, actually, I will be there.
How aggressive should we be at buying outside of the U.S. and or North America? Peter, what do you think with all the quantitative easing coming outside of the U.S.? What do you do?
Well, I think you want to avoid the U.S. You can invest in Canada. I mean, I think there are some names there that we like, but I also think you can look at Australia, New Zealand. You can look at Scandinavia. Those currencies have beaten up Southeast Asia, some of the emerging markets. In fact, if you look at the valuation of the U.S. stock market versus the emerging markets, I've never seen the U.S. so expensive or these other markets so cheap. So there are a lot of bargains out there, particularly if you happen to have U.S. dollars to go shopping. You know, people talk about, the strong dollar, go take a vacation. I'd rather use those overpriced dollars to buy real assets before the bottom drops out of the dollar and people figure out just how worthless they are.
Tom, what's the biggest risk that you're mindful of?
Well, I think the biggest risk has to be inflation. And if inflation were to materialize or move rapidly back towards the Fed target, then the Fed is going to have to move more aggressively, and you're going to have a full-fledged bond market tightening tantrum if that happens.
Gentlemen, thank you all very much for the discussion today. Certainly very different views, and that is, at the end of the day, what makes the market. We appreciate all of your insights and input. Thank you so much. That's all the time we have for the Fed and your investments, a BNN special presentation. And again, our thanks to Peter Schiff, Benjamin Tal, as well as Tom Tzouras for their expertise as well as analysis. Stay